Hey traders! Have you ever wondered how a currency suddenly goes up or down right after a central bank makes an announcement? Or how a small change in interest rates can shake up the entire Forex market? Today we're going to talk about one of the most important concepts in trading: interest rates, and how they influence the Forex market. Whether you're new to trading or have been in the game for a while, this topic could be a game changer for you. So let's dive right in. First things first, what are interest rates? In simple terms, when you borrow money from someone, the extra amount you pay back is interest. And when you deposit money in the bank pays you interest. But in trading, it goes a bit deeper. Here, we focus on central banks, like the US Federal Reserve, European Central Bank, or the Bank of Japan. These banks adjust interest rates to control the economy, sometimes to fight inflation, sometimes to boost growth. And when these rates change, it directly affects the value of that country's currency. Here's a basic rule to remember. When a country raises its interest rate, its currency usually becomes stronger. Why? Because investors can earn higher returns by investing there, and money always flows where there's more profit to be made. Let's say the US raises its interest rate from 4% to 5%, while Europe keeps theirs at 2%. Investors will shift their money into US bonds or stocks. But to invest in the US, they need to buy US dollars, so demand for the dollar goes up, and the dollar gets stronger. Now flip the situation. If a country lowers its interest rate, its currency usually weakens. For example, if Japan cuts its rate from 1% to 0.1%, investors may pull out their money and move it to countries offering higher returns, like the US or Australia. And when demand for that currency drops, its value naturally goes down. Now let's talk about a slightly advanced concept: interest rate differentials, which means the difference in rates between two countries. This difference plays a huge role in Forex trading. It's the basis of a popular strategy called the carry trade. In this strategy, traders borrow money in a low-interest country like Japan and invest it in a high-interest country like New Zealand. The difference in rates becomes their profit. And if the higher-yielding currency also appreciates, that's an extra bonus. Here's another key point. The Forex market doesn't just react to actual rate changes, it also reacts to expectations. Let's say traders expect the Bank of England to raise interest rates next month. People may start buying the British pound weeks in advance. So by the time the actual hike happens, the move is already priced in. And if the central bank surprises the market, like not raising rates when everyone expected it, that can cause a sharp reversal. That's why it's super important to follow economic calendars and central bank statements closely. Interest rates also give us clues about a country's economic health. If a central bank is raising rates, it usually means the economy is strong, people are spending, inflation is rising. But if they're cutting rates, it often means they're trying to boost the economy and encourage spending and investment. So when you're trading Forex, don't just stare at the technical charts. Look at the big picture: GDP numbers, inflation reports, jobs data. All these influence central bank decisions. All right, quick recap. Higher interest rate equals higher returns, stronger currency. Lower interest rate equals lower returns, weaker currency. The difference in rates between two currencies can move a Forex pair. The market often reacts to expectations before actual changes. Interest rate moves signal the health of an economy. If you truly want to become a smart trader, understanding interest rates is a must. Pay attention to what central banks are saying, what their tone is, and you'll start making better, more informed trading decisions. If you found this video helpful, make sure to hit the like button, subscribe to the channel, and smash the bell icon so you don't miss out on the next video.